Traders believe that all indicators lag because they react to price movements after they occur, potentially resulting in missed opportunities. While there is some truth to this belief, particularly with tools like moving averages, indicators should not be dismissed entirely. When used together, they can enhance trading strategies. Price action versus indicators. Critics of indicators often rely on price action for trading signals. It's essential to recognize that while price is crucial, it can also bypass key technical levels such as support, resistance, Fibonacci levels, or trend lines. Both indicators and price action have their merits and drawbacks, and no one can predict future price movement with certainty. Personalized trading approaches. Each trader has unique perspectives, risk tolerances, and methods that work for them. The effectiveness of a trading strategy can vary significantly from one trader to another. The author proposes a straightforward mechanical trading method that favors clear entry rules based on indicators or specific chart patterns, minimizing uncertainty at the entry point. The importance of patience, courage, and discipline. A key principle in trading is to exhibit patience in waiting for the right setup, courage to execute the trade, and discipline to adhere to the trading method consistently. This discipline extends to all aspects of trading, including risk management and personal well-being, underscoring the holistic approach required for successful trading. Example. Key point: lagging indicators can hinder timely trading decisions if relied upon too much. Example. Imagine you're watching the Forex market and see a noticeable price drop. An indicator, like a moving average, confirms this downturn after it has already occurred. You realize that if you were relying solely on this indicator, you would have missed the perfect opportunity to sell. This highlights the key point that, while indicators provide valuable data, they should complement your understanding of price action instead of leading your decisions, thus improving your overall trading strategy. Critical thinking. Key point: the role of indicators in trading strategies. Critical interpretation. Jim Brown emphasizes that while indicators are often criticized for lagging, they can still be valuable when integrated thoughtfully with other methods like price action. This perspective invites skepticism. After all, the utility of indicators can be subjective and varies among traders. There's a risk of over-reliance on these tools, which may lead to missed opportunities if market conditions change. Perspectives differ notably within trading communities, with some studies, such as those seen in Technical Analysis of the Financial Markets by John J. Murphy, suggesting a mix of indicators and discretionary approaches can yield better outcomes. Thus, while Brown's approach holds merit, it's crucial to remain open to diverse strategies and maintain a critical mind regarding the effectiveness of indicators.
You're watching The Rock Channel. Don't forget to hit like, subscribe, and press the bell icon for updates.